Real estate investment practice problem using Excel. Incremental borrowing costs, one loan versus two loans comparison. Get ready, because we're raising the stakes with real estate. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we have three tabs on down below: example, practice, and blank. Let's take a look at them now, starting with the example tab, in essence being an answer key. In a prior presentation, we looked at the incremental borrowing costs. We are, in essence, going to continue on that, looking at one alternative option related to it. So let's review what we had last time and then continue from there. We've got our two loan options that we're going to be imagining here. One at the home price of $150,000. We have the option to put 10% down, we're going to say, which would be $15,000. And the $115,000 minus the $15,000 would be a loan then of $135,000, 30-year loan, 360 months, at a rate of 8.5%. Payment then calculated using the PMT function or formula, $1,038.03. We compared that to the same home value at the $150,000 and putting $20,000 down, which would be $30,000. I'm sorry, 20% down, which would be $30,000. The $150,000 minus the $30,000 gives us $120,000 loan, and versus, of course, the $135,000 loan. Same 30-year time frame, 360 periods, but the rate is going to be 8%. The payment then at the $880.52. So this was our comparison. So the question then would be, the difference between these two amounts is $15,000, which we have in essence the option of either putting that $15,000 down, putting it into the down payment here, which would result in a lower loan amount. So we're basically investing it in the home in that way. Or if we have the option of just putting the 10% down and saving the $15,000, getting the larger loan amount, then we could take that $15,000 and do something else with it. The opportunity cost, we could put it into investments, but the question would be, how much would I have to earn on investments to make that a wise decision? Or possibly we can take out another loan. Would it be worthwhile to take out another loan that would cover the other $15,000 to cover basically the 20%, for example? So those are basically the two options that we can do. We're going to be comparing to that last option, meaning we take the smaller loan of $120,000, we put $15,000 down, and then we take another loan for the other $15,000. That's being the option that we're going to basically look into in more detail. Now, when we compare these two, obviously we can compare these two and say, okay, well, what's going to be the difference in the amount that we're going to put down? If we're just looking at the difference between these two, the difference would be that $15,000 down payment. The difference in the rates, we would expect the rates would go up if we have the loan and there's a substantial increase in the dollar amount. That's the way that loans typically work. It's going up in this example from 8% to 8.5%. And that, of course, is going to increase the payments as well. So we have the payments increased. So we can consider the trade-off between the payments being smaller under the smaller loan versus the larger loan versus the $15,000 investment. We can also compare basically the rates. We'd also compare the cash flow, but then we'd want to think about, what the incremental borrowing cost would be if we want to consider investing in some other option, if we have that option, or taking out a second loan. So we have these two amortization tables, and we figured out then the incremental borrowing rate. So I won't go into it detail here because we did this in a prior practice problem, but in essence, we took the difference between the loan amounts, which was $15,000, and then we took the difference in the payment amounts, which was $157.52. Then we can calculate the incremental borrowing rate, which is in essence the rate of, the cost of borrowing, with a rate function. We did it in this format, and we also did it with an IRR type of calculation. So that 12.28 about represents the real cost of borrowing the extra $15,000. You can earn an equivalent risk-adjusted return on the $15,000 that is not invested in the home. That would be one question. Or alternatively, can you borrow the additional $15,000 elsewhere at a lower cost? That's what we're going to consider this time, that second option. So then we also considered the calculation as if we were going to sell the property in 8 years instead of holding on to it till maturity. And we got a bit different calculation for the rate here. We calculated those two items as well using the cash flow, the differences in the two loans, the 15,000, and then the differences in the payments, and we get to our same two percentages, the 12.4, and we get to the amount down below of the 12.28. So now we're going to assume all that has been taking place, and we're going to assume the next option, or one of the options, which is to take out a second loan for the 15,000. So we have the smaller loan we're considering, and then we see if we can take the second loan out for 15,000 and consider what the rate would need to be. So we'll adjust the rate and kind of compare or prove, our calculations on the left-hand side. So that's going to be our objective here. Then in the practice tab, we'll have some pre-formatted cells all the way to the right, which will be in blue, so you can work through the practice problem with a little less formatting. And in the blank tab, we're going to have our information that will populate a little bit more, doing more formatting. So again, the whole left-hand side of the page is basically what we went over here, and it's going to be comparing what we did in a prior practice problem, the end result being that we have this 12.2279 difference. So now let's say, okay, let's assume that that's the case, and let's say I'm looking into that one option of another loan in more detail to try to better understand this. If I take out the smaller loan of 120,000, and then I try to finance with a second loan the added 15,000, let's consider that option. So I'm going to put on the right-hand side, I'm going to put another amortization schedule. Let's copy it over to do that. I'm going to copy this whole thing right here. Going to put my cursor on K all the way to S. Control C, copying that, and bring that on over. Bring it on over to column AH and paste it right there. And then I'm going to say, okay, well, what if I added another loan at $15,000 loan, and we're going to say that I'm not going to put anything down because I just want that to be the loan amount. So it'll be a $15,000 loan. That's basically our starting point right here. We've got the 30 years that we're going to assume, 360 in terms of the months. We'll just keep that the same for our example purposes. And then the rate, let's start with the rate at the 8.5 at the rate. I'm choosing 8.5 because basically the larger loan was at basically 8.5, right? So then if we calculate the payment on that, we get the 115.34. So our second loan, using our payment calculation, 115.34. Let's adjust our payments now in our amortization table because they are absolute references. So I'm going to delete the payment and pick it up from here, the 115.34 on the second loan, F4 on the keyboard, $ before the AI and 9, put our cursor back on it, double click on the fill handle, taking that all the way down. On the interest amount then, I'm going to remove the absolute reference and we're going to pick up the 8.5% right here, F4 on the keyboard and enter. And then I'm going to double click on the fill handle, bringing it all the way down. And then I'll double check going all the way down to the 30 years to see that we are in balance. It should be fully amortized or at zero at the end. That looks good. So the option that we have here, we got the lower loan and then that 15,000. So the loan that we're considering is this lower amount of the $120,000 loan, and then we financed the 15,000 with a second loan is our option instead of doing the larger loan for the 135. So that's going to be what our comparison will be. So if we consider that, then there is our amortization table. Now we have basically two loans that we would have. Let's figure out what our cash flow would be and kind of try to figure out what our rate would be on, in essence, the two loans. We're going to do an IRR calculation. So we'd say, well, okay, well then the IRR, if I had two loans, I have the cash flow, and let's say this is the IRR for the 30 years. 30 years. Let's go ahead and make that our header formatting, which is black and white. Black and white, and then we're going to wrap it and center it like so. And then we're going to say this is going to be 0, 1, 2, bringing that all the way down to the 360 with the fill handle. Drag in the fill handle all the way down, 360 payments, because that's 30 times 12, centering it, alignment and center. So there we have it. So then if we look at the total cash outflow, or we could think of it as the inflow, the loan that we got that we then paid for the home, it would be equal to the two loans. Now we're going to say, all right, we got a loan over here for the 120,000, plus we're saying we got this loan over here for the 15,000. So that would give us the 135. And then the outflows would be the two payments for the two loans that we have. So it would be negative of this payment way over here, which is going to be 881, minus this payment over here, which is going to be 115. So those two payments are going out, which is going to be the 996. Then I'm going to copy that all the way down. I'm going to double click on the fill handle, copy that all the way down like so. And then if we go down to the bottom here, we're going to say, okay, let me go all the way down to the bottom and do our totaling. We're going to say total, summing this up equals the SUM. And we'll sum this whole thing up like so. And pick that up. And then, so there's our total. And then let's take our IRR calculation equals the IRR, the rate at which this series of payments then would be 0 for the two loans. So we'll bring that all the way up. This would be the monthly IRR, formatting it as a percent number group, percentifying it, adding some decimals. There's the monthly percent. We want the yearly. So we're going to double click in it, go to the end of it, multiply times 12. There's the yearly at 8.06. So there's our 8.06 on the yearly amount. And of course, that is less than the 12.27 we got to here. And if we look at the loan, the large loan, if we took out the large loan instead of having the two loans, we had the rate of the 8.5. So let's look at it a different way to kind of prove this calculation. Let's say, okay, well, what if I took out this other 15,000 and we have these two loans and I use this rate, meaning the incremental borrowing rate? What if I can get a loan for that incremental borrowing rate? Notice that I'm not taking into consideration closing costs or anything here on the second loan. I'm just using this rate here. So let's take the rate and say, well, what if I use that 12.279 rate, 12.28 about, and then we got this all calculated out. It's picking up the proper payments now based on that information. If we look at our cash flow and our IRR at the end of the day, then that's going to be then that 8.5. So there is our 8.5. So that's kind of proving the point here, because this point can be a little bit abstract in that we're saying that 12.28 is the rate that we would basically need in order to get kind of like that second loan. If we basically had the two loans, we'd have to be beating the 12.28, not the 8.5, right? If I got the second loan for the 8.5, that would be good. Anything under the 12.28, although of course we'd have to be taking into consideration the closing costs. That's the rate we're kind of looking at, because if I use that rate, the 12.28 for the two loan scenario versus the one loan scenario, then I get to an IRR that's equivalent to this 8.5 rate on the one loan type of scenario. Okay, let's try it. Let's do it again. And let's say, well, the second option that we said, well, what if we stop it after 8 periods and we calculated the rate that would be the incremental borrowing rate, in essence, if we weren't going to hold on to it for 30 years, but only for 8 years, and we came to the 12.4. We did it in this format. We also did it by basically calculating it out with the IRR calculation. Let's do that same thing to kind of prove the point in terms of our second loan type of scenario. So let's say we took out this second loan and we're going to basically close this thing out after the 8-year time frame. So we're going to say after 8 years, and we'll keep the rate where it is now, so it won't be exact because we're using the second rate, but we're going to say, okay, let's do this, copy the same thing. I'm going to copy from the skinny cell on over and copy that and put that here. And so now we're going to say the IRR for 8 years, it's going to be the same. So the 135, I'm going to say this is going to be equal to the payment. I'm going to copy that all the way down, except I'm going to stop after 8 years, which I can see over here in the years column. 8 years stops right there. So everything under that we're going to remove because that's after 8 years. So we're not going to be using it because we're stopping. As we stated, after 8 years, that's what we're doing. So everything underneath, we're going to delete. So I'm going to right click and delete that stuff. Move the cells up. Going to total this up. Hold on a sec. Before we total it, we're going to have the ending balances, which will have to be closed out here. So we got that same 1,038 payment, and we're going to subtract out also the balance of this loan right here. The loan, it's going to be way over here. That was the 881 payments. So we're going to have to pay off another balance of the 109,221 minus, and then we're going to take the loan balance right there of the 14,347 for that $15,000 loan that we'd have to pay off. There we have it. Now let's total it. Total equals SUM, shift 9, picking up this whole column. And there we have it. So we got the 88,219, and the IRR then would equal the sum of this column. And that would be the monthly IRR. So not the sum. What? It's the IRR. It's the IRR that we're doing, not the sum. So we'll take the IRR, the rate at which that series of cash flows would be 0, add the percent, add some decimals. That's the monthly amount. Double clicking on it, going to the end of it, multiplying times 12 to get the yearly amount. We're at the 8.48. So 8.48. And then if I change that number over here, if I say, well, what if I make the interest rate on this second $15,000 loan equal to the incremental borrowing cost that we came to, the 12.4, then we should get to the 8.5 again if we stop after the 8 years. This one will now be, you would think, 8.5. This column will now be slightly different given the fact that we've now changed it. So it's 8.51. Now again, that 8.5 matches, in essence, what the rate would be if we combined or had one loan at the 135. So that's kind of just trying to give us a proof of, in essence, the two loan scenario versus the incremental costs of going from a smaller loan, in essence, up to then a larger loan. Now you can also, of course, the cash flow in general. So in other words, if I change this rate back to the first incremental, which is that 12.279, making the 30-year cash flow equal to the 8.5 here, and I compare that with the two loans compared to the one loan, which are as close as they can be or having the same IRR, we got the payments between the two would be the 1,038 on the two loan scenario, and we basically have, in essence, the same payment here. The total payments, if I was to multiply that times 12, would then, of course, be the 373,692, which would, in essence, be basically the same. Obviously, if the payments are the same over here, so if we added up all the payments, so you can look at it from a cash flow type of standpoint as well, adding them up, 373,692 versus this one is going to be the 373,692. So we got those lining up as well. Note that in some scenarios, if you had different like loan terms, then you could, it could complicate things. You could have the same internal rate of return, but if you had different like loan terms and whatnot in terms of the length of the loan, for example, then because of time value of money, you might not end up with the same total cash flow, but the same rate of return because of, time value of money calculations. But hopefully that gives us kind of solidifies this concept of the incremental cash flows a little bit, and also gives you another kind of way that you can do the comparisons that might make more intuitive sense, which is in essence simply making a two loan scenario versus a one loan scenario. But it's a lot easier to do that if you get this incremental rate, and then you can kind of prove where that break even point is between the two, and then put into consideration the closing costs and that kind of stuff, which will complicate the story a little bit. So let's do some formatting now. Let's highlight this whole thing and do our blue border thing to it, because that's what we do here. We've got to make it look nice. This is our branding. It's got to look good so people know who's doing this stuff. So we're going to do this one here. We'll make that the blue and borders. So there we have it. And then we'll do the underline down here. Do the underline. Everything needs to be professionally put together, looking nice. People should just be impressed. They'd be overwhelmed by the numbers and impressed by the formatting for formatting's sake. And that's what we need. So there it is.